I know that Tim wants to talk about, football, but we're here to talk about retirement and finances. Welcome, everybody, to Retirement Compass Radio Show with Stonebridge Wealth Systems and Tim Kulhanek in the Lincoln office and Jeff Gove in the Kearney office. So do you want to do football talk for a minute?
Not much to talk about just yet. I mean, we're recording this a little bit early this week, and so, we got one game under our belts, and they could have taken the belt out and used it a little bit harder on those Bearcats from Cincinnati, but
1-0.
Just wait, 1-0. 1-0. Was it last year we played Northern Iowa or whatever, and it was like, this isn't near as good as I thought it was going to be, especially defensively, but then the defense turned out to be pretty good. It's a different defensive scheme. We don't have like polar bears up front like we did. We don't have Nash and Ty, and so it's smaller, maybe more agile guys, even though Ty ran like a 4.7 40 or something insane at the combine. He's like 300 pounds and he's going 100 miles an hour. It's scary, but we'll see. I think they just they're young guys that are going to take a little bit of molding, but 1-0.
I hope that big guy has some long-term care insurance because he might have some orthopedic problems later in life. I'm just saying. All college football fellows. All right, I tried to loop it in there for you.
Well, I mean, it's not just that, though. Anybody who was like a bodybuilder, was it Ronnie Coleman? Lightweight, baby. Lightweight. The guy could barely walk today. I'm not joking. Like, he can barely move. And so it's no joke that playing, higher level athletics, especially contact sports, whether it be football or, rugby or something like that, something that's high impact. I mean, it's going to have lasting effects. There was a guy that worked at the bank I worked at when I was in, I guess it was my freshman year of college, I think, when I started working there. And he had been an offensive lineman at the 49ers, I think is who he played for.
Oh, wow.
But you could tell he really, it affected him, his joints, his back. It leaves an impact. So, it does tie in a way, Jackie.
It does. I tried there a little bit for you.
Well done.
Thank you. Well, I thought we could talk. Let's start with the saving that people do and the savings that folks do for their retirement. And I hope young people start with some savings and don't overlook this until they're 45 and go, I haven't saved any money. Because eventually those RMDs are coming for people. And, of course, that's much farther down the road in your 70s. But let's talk about our retirement and how to get saving and how to protect the money, even if we are at RMD age, right? We're building up, Jeff and Tim, this 401k, IRA, and now it's time to take the money out, for example. So before you do, the IRS has rules. It's money with rules, and they are going to come and flush out that cash so that they can collect their taxes. I think that's rather unfair.
I mean, it's just the way the rules are, though. It's money that's never been taxed. And so, there's been some changes with this through not only Secure Act 1, but then Secure Act 2.0. It used to be at 70.5, and we don't really know why they chose 70.5. And that was what we call your required beginning date. And your first RMD was due by April 1st of the year following the year you reach age 70.5 back then. And then Secure Act 1.0 was passed in December of 2019, I think it was. And then December of 2022, Secure 2.0 came along. And long story short, if you were born in 1960 or later, your required beginning date is age 75. If you were born before that, you either have already reached your required beginning date or you will here in the next year or two, because your required beginning date would be age 73. So in the next few years, I should say. And so why this is important is there is a penalty. The IRS has been pretty lenient with the penalty and willing to waive it. That isn't, like, just to be clear, that isn't to say, oh, well, don't worry about it. Like, no, you need to, because they could, literally this happens, they could one day say, yeah, no, we'll waive that penalty. And then the next just say, look, tough, pay up, right? And that penalty used to be 50% excise tax. It was like one of the I think the highest excise tax in the U.S. tax code, or one of the highest excise taxes. Now it's down to 25%. And if you correct the missed RMDs within, I think they called it a reasonable time frame, which we're under the impression that's like within 2 years, they might knock it back down to 10%. Again, a lot of times, if you can give a reasonable explanation to like, hey, there was a health issue, or hey, I worked for this old employer, they rolled the money to an IRA, I didn't even know the thing existed. That's the only reason they're probably going to be more reasonable with that sort of thing, but they don't have to be. And so understanding the rules of the game, like you said, well, let's start by talking about football. Well, just imagine if you didn't know, like basketball is a little bit easier because I have little kids, and when they start playing, they don't know you have to dribble. And so there's like the rules of the game. They just like, they'll dribble a couple times and they'll run for a while and they'll dribble a couple more times and throw it to their friend. You have to know the rules of the road in order to make sure that you stay within those boundaries that the government has set. So required minimum distributions, really important. And one thing that I just want to mention is, and we'll get into more of the details of this, but so many people think, I get to wait until April 1st of the year, following year I reach age 73, let's say, for folks today, right? And so therefore, I don't actually have an RMD. Let's say, for example, that I was going to turn age 73 next year, and I got money still in a 401k from a former employer. I've separated from service. I don't work there anymore. So the still working exception wouldn't apply even if my employer offered that. And I'm like, but I really like this plan. I don't need the money. I want to keep it in there. So I'll just leave it in there until April 1st of 2027, because I'll turn 73 in my example in 2026. Understand that you still have an RMD due for 2026. They just give you for your first RMD a 3-month grace period to take that out. So you'd have a second RMD that would be due by December 31st of 2027. So you'd actually be piling 2 RMDs in 1 year. So you're lumping distributions together in 1 year, which could increase your tax rate, your effective tax rate, push you into a higher bracket. But more importantly, it's going to impact your modified adjusted gross income, and modified adjusted gross income could cause additional taxation on Social Security, could cause you to have to pay more tax on long-term capital gains, could cause you to pay more for your Medicare through surcharges, or what we call an IRMA. So there's a lot of reasons to make sure that you're making good decisions on when to take that money out and timing it properly. And number 2 is, if that money's in a 401k, you can't roll over your RMD. So many times people will be like, then before April 1st of 2027, in my example, I'll just roll that money out to my IRA, and then I'll take, that'll do a QCD maybe. I'll do a charitable distribution, and I won't have to pay tax on any of it. That'd be a prohibited transaction because what we call an excess contribution to an IRA, because you can't roll over your RMD. And if the combined RMD, so you'd have 2 RMDs you have to take before you can do the rollover. And if the combined amount was $50,000, but you mistakenly roll that to your IRA, well, you have an extra $50,000 in your IRA now that you shouldn't have in there. And so now you have to go through the whole, rigmarole of figuring out, how do I correct an excess contribution? I got to take that out, plus the net income attributable, and there's a formula we have to follow. It gets pretty complicated. This is why having a guide, somebody who's landed the plane before, so to speak, can be really helpful when it comes to this distribution phase of your life.
Sure. And that would be you, either one of you. This is the number that is kind of centralized. You can use this number to call, and then you'll land at the right office. Just place the call, 866-295-5146, 866-295-5146. Stonebridge bringing you the Retirement Compass radio show. And this is a very specific vocabulary that you're using. This is a communication language that the average person is not familiar with, Jeff.
It is. So a lot of people don't even know that they have to take money out of their IRAs, 401ks. One of my old neighbors, he had probably the biggest 401k I'd seen for somebody that was in their 30s. It was right at $1 million.
Nice.
And he said, he had a family farm and all these other things. And he said, I'm never going to touch this money. Well, rule of 72, that's going to be a big amount of money by the time he hits his RMD age would be 75. So the required distribution is going to be hundreds of thousands of dollars that he'll have to take out of there if he doesn't do any tax planning before then. So you have to keep in mind, when you put money in those 401ks, it is a good thing. So we're not saying don't put money away. What we're saying is, let's look at the tax ramifications of putting money where you're putting it. So when you put money in the 401k, you're deferring it. You're not, you deduct it today and then you're deferring it, which means later. It's not tax free. You're going to pay it later. So have a plan for when you have to take that money out, because like Tim said, it's not just paying tax on those dollars that you're taking out. It's the other ramifications of, you're paying more tax on your Social Security. You're paying tax on long-term capital gains that before you weren't. There's a lot of different things that it could impact.
That's good stuff. When we come back, I feel like I want to suss out the difference between the rules for an IRA and a 401k, because maybe people don't realize that they're two different things. I'm just speaking from the common person's perspective, but I want to hand out your number first, 866-295-5146, 866-295-5146. And what's that? You like that?
Call the number.
Call the number on the
Click
screen.
the little code thing.
Click the code thing.
And that it's good.
Follow, like.
Yeah, go ahead and use
things.
Subscribe.
all the things. Subscribe. Yeah,
Follow,
I'm
like,
getting
and
there.
subscribe.
Yeah, call, like,
Comment.
subscribe,
Good.
comment, all the things. Yes, because the YouTube channel is Stonebridge Wealth Systems.
Yeah, it's live. It's running.
Oh,
See us
good,
there.
good. Oh,
We're dressed up
fantastic.
today. Like, can you look at this? We got a ribbon cutting going on in Kearney. We're cutting ribbons.
Fantastic.
Giant scissors are involved. It's
Oh, I love it. And the
wonderful.
mayor?
The mayor.
Oh, that's cupcakes. I'm reaching. All right,
Cookies.
866-295-5146. Be right back.
Did you ever think your retirement would be shared with our government? It's true. Your traditional 401k, IRA, pension, or similar retirement accounts are like a partnership with the IRS. Simply put, they want their tax dollars, and you have them. With our latest tax calculator, you can plug in your own numbers while sitting at home. To find out what your future tax liability could be, scan the QR code or go to stonebridgetaxbill.com.
Here we are on the radio, on YouTube, on podcast form, Retirement Compass radio show with Stonebridge Wealth Systems at 866-295-5146. Well, could you please explain the difference of the rules in an IRA and a 401k? Because I think that people don't understand, by and large, unless they've studied it and they've listened to the show and they have a little bit of understanding, but not many people understand that the 401k does not belong to you. It is your money in there, but it belongs to the company that you worked for. Is that correct?
A 401k is an employer-based plan, so it's a pooled account. Mm-hmm. So technically, it's like, think of it kind of like one big account that's then separated out by a group called a record keeper that keeps the records to know whose money is whose.
All right.
And they separate it by money type, so they do what we call separate accounting.
Okay.
So they look at, for example, when you get your 401k statement, you think about it, they'll show you elective deferrals, they'll show you a match, a profit share. There could be discretionary, non-discretionary employer match. Like, there's a lot of different categories that can go into that, and that just all depends on plan design. For example, here at Stonebridge Wealth Systems, we try to take care of our people. We figure if we're in the financial industry, we should have a competitive package as far as benefits go. And so we have what's called a safe harbor plan. We match dollar for dollar on the first 6%. So employees would have their own elective deferrals that they're doing up to the max. And then also they'd have a 6% match on top of that. And it'd say safe harbor match, because that's the type of match it is. It means they're vested day one in all of the money, not only what they put in, but also what we matched.
Oh, now that's unusual, Tim, because not all companies do that.
A lot of companies will do either cliff, like a 3-year cliff, or 2 to 6 year, so 5-year vesting, where after one full year, the first year it's 0, and then after a full year, you're at 20%, 40, 60, 80, 100. But you can't do a safe harbor for that. Safe harbor just adds some more flexibility in plan design for all the employees, in our opinion. And it's more generous, right? I mean,
It's very generous.
you got to take care of your people, because they could walk away the next day and take all of their money and yours with them. But as it pertains to 401ks, so IRAs have what's called the aggregation rule, which means if I have an IRA at Charles Schwab, at Fidelity, at Pershing, and I have a 401k, at Vanguard, at Betterment, at you name it, at the bank, and these are all traditional IRAs. What I do once I reach this magical required beginning date is I calculate the RMD, which is based off the December 31st balance of the prior year. So my RMD, if I'm subject to RMDs, let's say that I turn 73 next year, like my previous example, we'll just continue with that hypothetical.
Okay.
So I'm turning 73. I don't know what my RMD is going to be until basically January 1st of next year, because the December 31st balance of this year, 2025, it's what the baseline or benchmark is going to be on all those accounts to determine my RMD for the next year. So then we get that benchmark. We then apply the IRS mortality tables and say, okay, well, here's my balance in this account. I divide by this number. This account, divide by this number. And you come out with what the quotient is, or whatever the answer is there for division. I can't remember for sure. Then you add all those up. So I find my 5 RMDs for my 5 IRAs. I add them all together, and it's like, oh, well, I've got $27,352 I've got to take out in 2026. Here's the great thing about IRAs. Here's where the flexibility comes in that I don't get with a 401k combined with an IRA is I can aggregate, which means I can take a little bit from each of them. I could take the RMD that I calculated from each account, or maybe I've got a setup where some of my accounts I've got in more of a principal protected, what I call volatility buffer environment, where I'm that's my rainy day fund in a sense that it's the money that I would access in the event of a bear market, right? The stock market, as Jackie would say, goes down, clawed down. Then I want to be able to access money that is principal protected, that's safe, but there could be liquidity provisions / restrictions. I probably wouldn't tap into that money if things are going well in the market. I'd rather aggregate and take all my RMD from maybe 1 or 2 or 3 instead of all 5, right? So you've got some flexibility there. With 401ks, if I had those 5 IRAs and 1 401k that I just kind of laughed and, I'm not working there anymore, but I'm going to leave it there, I can't do that. I'd have to take a separate RMD. So if I made the mistake of, let's say I took the full RMD from my IRAs and I aggregated the 401k money and took extra from my IRAs to account for the 401k, Jeff, what's going to happen?
You're not going to qualify. I mean, you can't aggregate a 401k.
I voluntarily paid extra tax, took extra money out that I'll not be able to put back in if I don't catch it within 60 days. And I have a missed RMD from my 401k.
And so it'll double up once you do aggregate the...
So then you realize it,
Right.
and you're like, oh, shoot, now I've got to take that money out. I'm paying more tax because, again, I voluntarily, that's my point, is I took more money out than I needed to from my IRAs because I still have to take that money. So if the 401k portion of the $27,000 was $7,000 and I took $27,000 from my IRA, I got to take another $7,000 from the 401k in order to actually satisfy the RMD. Now, if you're listening to this and you're like, dude, slow down, my head's spinning already, that's exactly why when it comes to the value a financial advisor, a good financial advisor can provide to their clients, it goes way beyond making, sense of just your investments, so to speak. It's not about buying better mutual funds, getting better rates of return. Because the reality is most money managers on Wall Street, they're going to experience what's called mean reversion, which means they're going to, over time, probably average close to or actually a little bit less than what their benchmark index would return. So if it's the S&P 500 or the Russell 2000 or Russell 1000, whatever their strategy is, most of them aren't going to outperform that unmanaged benchmark. And so how, as an advisor, can you really provide value? Well, to me, it's really about the fact that your investing career or your investing life cycle, if you will, it just like anything else, just like your working career, it goes through phases. And, you start off and you're in the introductory position, you're learning the ropes, you climb the corporate ladder maybe, or you hop around, but eventually you get into more of maybe a leadership role at some organization. You're now the senior, most experienced, seasoned veteran employee. And then eventually you phase into retirement. And it's like, hey, now I'm going to pass the baton. With investing, it's similar, but those different phases, they carry their own set of risks and rules. So we're talking about the rules of the game, right?
Yes.
There's a lot different rules that you have to contend with. And so one time I heard somebody explain it like this. They said, think about, so my dad was in the Navy. Okay, my dad, Jim. Jim spent 4 years in the Navy. He was on the USS Holder, DDA. I can't remember all the numbers that go with it, but and he talks about it all the time. Like, he's very fond of his time in the Navy, and he talks about the challenges of being out when they're underway and they're in the Atlantic Ocean and they're trying to deliver supplies, and somebody's flying a helicopter to drop supplies onto the deck of the Holder.
Ow.
They're coming over the fantail. The net gets cut from this flagstaff, and a bunch of giant shells with Willie Pete fall on top, and he's underneath and he can hear it. And if they would have cooked off, how much it's a hazardous thing. But no matter how experienced the captain of those ships are, once they're coming into port or to the harbor, it's like a big destroyer or a cruise ship. There's somebody else. So if you've ever been on a cruise, you've seen this where that little boat comes out, and somebody climbs aboard. So that's called a harbor captain pilot, okay? So as you're coming into port, there's somebody who's a specialist in that specific technique, right? That specific phase of the journey where you've got all these cables and you've got different things that are underwater that you have to navigate.
Yes.
You've got all these different potential hazards and landmines, if you will, not literally in that sense, that you've got to be able to navigate around, that otherwise you could be moments from calamity or disaster. That's kind of how I think about retirement is, you really need the captain of the ship while you're in this accumulation phase and you're socking money in the 401k, you've got your head down, you're working, you're really not thinking about what comes next or how you're going to take this money out. That's a totally different game plan than once you get into this retirement, this distribution phase, and you've got all these different potential risks and threats and RMDs and QCDs and IRMAs that you've got to contend with. So really the role Stonebridge plays is we're that harbor captain pilot where we come aboard and we say, hey, listen, this is navigating the hazards that are ahead is something we do for a living. That's our specialty.
Great. Use this number. Get that specialization. 866-295-5146. 866-295-5146.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Retirement Compass radio show with Stonebridge. Jackie Selby over here, Stonebridge over there. I have in the Kearney office, ready to cut the ribbon here today on their new office and their opening. It's very exciting. Mr. Gove, Jeff Gove, and Tim Kulhanek in the Lincoln office. Now, we've been talking about RMDs and 401ks and all the fun acronyms. But what about a Roth 401k? How can this benefit, and when should somebody take money from their regular IRA and put it into a Roth, tax advantage-wise? What is the best strategy here?
Well, everybody's situation is different, I guess, first off. We don't want to just say everybody should do the Roth 401k or everybody should do traditional because you can actually do a mix. You could do some of both. But let's say you were just into the 22% tax bracket. We may do some in the traditional to get you down to the 12. But then we wouldn't want to keep reducing your income when you're in the 12% tax bracket. So then you'd want to do some in the Roth where you're paying tax on it today and it's going to grow tax free. So that's one thing to consider. As far as moving money from traditional to Roth, it is a good plan, but you have to be careful with that if you're trying to do it on your own, because you could put yourself in a much higher tax bracket. If you're not 59 and a half and you have taxes withheld from that conversion, you're gonna pay penalties on that conversion, on the tax amount. So there's a lot of different things that you have to consider, and a lot of different landmines, like Tim was talking about, that you could run into. And we have the information, so just give us a call.
Right, 866-295-5146, 866-295-5146. Retirement Compass Radio Show, also visible on YouTube now. Just go to the YouTube page, Stonebridge Wealth Systems. Please like it. Let's get our numbers up. If you enjoy the radio show, please go to the video show. And you could even use the code that we have at the bottom of the screen, QR code for fancy people, right? And
The
then
QR code.
Yeah, QR code. I associate myself with the not so fancy people, but let me see, Tim, what you say about 401k, Roth 401k money. How does this apply to the self-employed person or the person who is owns a family business, farm, etc.?
I thought you were starting the Star Spangled Banner for a second.
You did?
Oh, say, Tim, could we see how much? Where is she going with this? Let me just give you an example of a plan design I'm working on right now that I think is really exciting and can really have tremendous impact for our folks out there who are self-employed. Maybe you have a few employees, but they're not W-2 employees, or even if they are, maybe it's a small dental practice or family, like a private medical practice, something like that, and there's maybe a handful of employees, maybe 15, 20 employees. And this is especially helpful in those situations for folks that are nearing retirement and feel like they want to get kind of caught up. Maybe they're at their highest earning years and they feel like, hey, right now I'm paying a lot of taxes. I'm in the 32 or higher tax bracket. So you've got 0, 10, 12, 22, 24, 32, 35, 37. So 32, 35, 37 folks, this is especially beneficial for you because you're like, you know what, I'm not going to continue to be in this tax bracket. So I'm working on a plan design right now. It's a business that's essentially, it's a husband-wife. It's 100% owned by him. It's his business. She is an employee as well as him. So they pay themselves. They're an LLC, but they file a Form 1120-S, which just means they file as a Subchapter S corporation for tax purposes.
Okay.
They pay themselves a wage, so he's a W-2 employee. And then any income that doesn't, if you think about that, like their gross revenue, you've got all their expenses, so their vendors, their cost of goods sold, all that good stuff, their wages, payroll taxes, all that stuff. And then anything that's left over would be what we call PTE income or pass-through entity income. So what happens is you've got these folks like this that pay a lot of income tax right now because of where they're at in life and their higher income, because if it's an S corporation, like this might have tripped some people up with what I just said. An S corporation, even though it's a corporation, it doesn't pay corporate income tax. It all funnels down. That's why it's called a pass-through entity.
Okay.
It all passes down to your individual return. So anyways, long story, a little bit shorter. We can set up a plan where we've got a 401k. It's called a solo 401k. And yes, both husband and wife can participate, even though it's called a solo 401k. It can be a pooled account. So both of them, technically, theoretically, could be in one account. You set it up at a third-party custodian like a Schwab or a Fidelity. And we max fund that. Now, $23,500 if you're below age 50. If you're above 50, you could put an extra $7,500 in, which comes out to $31,000. However, starting this year, January 2025, individuals attaining ages 60 through 63 during the calendar year actually have a different set of rules they go by. They get the $23,500, but then they could, instead of $7,500, they can put $11,250. So, it's like $34,750 or whatever that they actually can put in. So all of a sudden we've got these beefed up, we call them super catch-up contributions for people. And again, like, why did Congress choose? Because they don't know what they're doing. Like, they do and they don't. Like, there's no rhyme or reason to it. So let's just assume for our example that these people are not yet 50. So it's $23,500. They can then do a profit-sharing plan. And normally you can do 25% of your W-2 pay. But for this plan, I chose 6% because I said, I want to make this a little bit more exciting. So we choose 6%, and let's say they're paying themselves $100,000 each. So that's $6,000 per person, $12,000 total in profit share. So we're at $23,500. So call it $47,000 between the two of them in 401k. That's deductible, so deferred, I should say. Then add 12 to that, and we're approaching $60,000 in tax advantage dollars. Mm-hmm. Now, here's where it gets exciting. We add an element through the TPA record keeper that we design these plans through called a after-tax 401k provision. Now, why would I want to put money into an after-tax 401k? I don't get any deduction. What's the point of it? Well, one would be if you wanted to put more money in and then let it grow tax deferred, and then you'd get the pro rata rule on the way out. A portion of it would be taxable, a portion of it wouldn't be. But I say don't do that. What I'm doing is I'm using a strategy that it's a loophole, but it is what it is, called a mega backdoor Roth, where they can fill the rest of that 401k up to the, I think it's like Section 415 statutory limit, which in 2025 is $70,000 per person. So we take the $70,000 and we subtract the $23,500, and then we subtract the $6,000 that I got from profit sharing, and we say, hey, there's like, what is that, $40,000 roughly that they can put in after-tax contributions. Now I'm rounding here, but $40,000 per person, $80,000 as a husband and wife they can put in an after-tax bucket. Now again, not specific advice, mileage may vary because you have to make sure that your plan document is designed to allow this. You can't just go and set one up on your own and assume this is going to work. But what do? So we do that $40,000, and then we immediately, after we put it in this after-tax bucket, we don't invest it. We just put it in literal like cash. Like we don't want it to earn anything. And then immediately we convert it to Roth. We have a provision within their plan document that says it can be converted to a Roth IRA. Nice. So what did we just do? In 1 year, so far, we've got $60,000 that's deductible. We've got $80,000 that's going to be in a tax-free environment, growing tax-free for the rest of their life. So what they put in will be tax-free when they take it out. All of the earnings will be tax-free. And then to tie a bow on this, we overlay that with what's called a defined benefit cash balance plan. And assuming they're paying themselves, let's say $120,000, it depends on their age. There's a formula here, but we're talking about a 1-to-1 contribution for a lot of times. So, they paid themselves $120,000. They could probably put another $120,000 per person into a tax-deferred vehicle. So we take the 60 plus the 240. We just put $300,000. And if you're older, if you're like in your 60s and 70s, like take these numbers and double them potentially. But like $300,000 in a tax deferred environment, where in the state of Nebraska, if you figure your state tax liability would be 5.2%, you combine that with being in the top tax bracket of 37%. I'm just doing the math just to make sure I get that right. You're saving like $127,000, or you're getting deduction to offset $127,000 of total tax by using this strategy, and you got $80,000 that are growing tax-free for the rest of your life.
Now that is what I call a strategy. Holy cow.
That's pretty sweet.
Yeah, is your brain on display at the Smithsonian or something? What is your, I don't know how you said all that just by memory. That was Tim Kulhanek. All right, 866-295-5146. You can reach the Stonebridge folks at that number. It doesn't matter where you want to talk to someone, where you want to be seen, if you will. Grand Island. John is in that office, and Jeff is in the Kearney office, which is about to have their ribbon cutting, which is exciting. Or you have Tim in the Lincoln office, and Zach. He was fun a couple weeks ago. A little green around the gills, and then Eli is over there in Omaha. He did a great job. I know it was fun for all and sundry. 866-295-5146. Call Stonebridge and get these brains to working on your situation. It's all right. You don't have to understand the vocabulary that Tim just gave us a lesson on. But the end game is to have a tax strategy that you can live with and that you can see some benefit from for your retirement years. That's the whole idea. So get on this, 866-295-5146.
Is your retirement being eaten up by financial termites like hidden fees, inflation, and avoidable taxes? Call today for a complimentary financial review so we can help you root out these retirement killers.
Let's talk about some scenarios with people who are retirement age. I've got a scenario here. 62 and 63 years old, recently retired with an IRA worth over $1 million combined. And they're thinking about doing Roth conversions before the RMDs, of course, at 73. But can you talk a little bit about the tax hit? Of course, this would worry anyone. How do you manage the future taxes on this?
So your question is, does it make sense to do a Roth conversion? And that's the perfect question to be asking. And really the only answer to that is a very attorney-like answer, which is it depends. But here's what it depends on. Let's talk about it.
Okay.
Depends on tax rates. It doesn't depend on, the growth that you would get on the additional money that wasn't converted. So there's a myth out there that says, hey, if you just want to picture this in your mind for a second, if I've got $1 million, okay, now write $1 million on your chalkboard or your whiteboard.
Okay.
And then a line at an angle down and to the left and one down and to the right.
All right.
Down and to the left is the option to just keep it as is. So do not convert on the left-hand side. So the line goes down and to the left. I got $1 million today. 10 years later, if I earn, we're going to put some assumptions into play, 7.2% per year, my average return, over 10 years, using what we call the rule of 72, how much money will I have at the end of 10 years? You know, Jackie?
No.
So, essentially, the rule of 72 is what you use to figure out how long it takes your money to double. And so if you use 7.2%, you take 72 divided by your interest rate, you get 10 years, okay? So in 10 years, my money will double. All right. So my $1 million is now worth how much?
$2 million.
Very good. Now let's assume, just for the purposes of our exploration here, that our combined federal plus state tax rate is 25%. That's pretty competitive. I think that's probably pretty low, personally.
Combined, yep.
But we're going to go with 25%. Now, leave that as is. Ghost run on first. Go to the right-hand side, down and to the right. This is the option to convert, okay? So we got $1 million. We convert all of it at once, and magically we get 25% effective rate. Again, this is for engaging in hypothetical, just for illustrative purposes only. How much do I have to pay in tax on $1 million at 25%? $250, right?
Right.
So $250,000's gone. Okay, that's going to pay taxes. Mm-hmm. So this is where people get tripped up because they think, hey, now I'm earning 7.2% on $250,000 fewer dollars. There's no way that this would ever make sense. I want to make sure I'm making that 7.2% on every penny. Okay, let's think about it. I convert today. I've got $750,000 left over. I then earn 7.2% over 10 years. How much money do I have at the end of the 10th year? I was at $750. I'm at $1.5 million, right?
Oh, okay.
So here's the two options. Down, if you think of the tree, you've got $1 million up here.
Right.
This is leave as is. I got $2 million. Convert. Yes. 750 goes to 1.5. Which one was better?
Convert.
Why? Because it's 500,000 less. How is it better?
Because there is a growth opportunity.
Well, you got growth opportunities in both of them. They both earn 7.2% is the point. But here's what matters. What haven't we done with this money over here, this bucket? We haven't paid taxes. So if we're generous and we assume 10 years from now, tax rates are the same, they're still 25%, and I take that money out because we're going to keep it apples to apples. If I take $2 million out and I got to pay 25% in taxes, that's how much in taxes? $500,000. How much money do I get net after tax? $1.5 million. $1.5 million and $1.5 million.
Oh.
It's exactly the same. So the only thing that matters is the tax rate. So you have to ask yourself, are taxes going to be higher or lower in the future? Right now, folks, so like the government, I don't know if it's the BLS or who it is, what agency, they put people into quintiles for their income. So the lowest quintile, the upper quintile, the middle, and then upper middle and upper low to mid, whatever it would be. So let's just look at that middle quintile, okay? So quintile means fifths, right? So the middle fifth of income earners in America, their average effective tax bracket right now is 22%.
I knew that one. You didn't ask me.
What was it in 2000, 25 years ago?
It was higher.
How much higher?
I don't know. 30.
Yeah.
35%?
30% higher. In other words, it was 28%.
Oh, okay. It was 28%.
So 28% higher, which is 28%.
Okay.
No coincidence intended. My point is, we're spending more or less money today than we were 25 years ago as a country.
More.
Way more. Okay. In fiscal year that ended 2024, so now we're going into a new fiscal year here, but the fiscal year that ended in September 2024, the U.S. government brought in roughly $4.9 trillion in revenue. They spent roughly $4.1 trillion on what we call mandatory spending. So that's things that Congress, when they do appropriations bills, doesn't impact. So things like Social Security, Medicare, Medicaid, government pensions, VA benefits, like stuff that hey, you know what, you can't change this. You could, but you'd have to change a separate law, not just pass a spending bill. Okay. So that's 4.1. How much did they spend on debt service?
Ooh.
Around $800 billion.
Oh, boy.
So if you add $800 billion to $4.1 trillion, you get $4.9 trillion. How much did I say the government brought in? $4.9 trillion. How much did they spend on mandatory items plus interest? $4.9 trillion. There's no money left over for any of the other stuff, which is why we have deficit spending of $2 trillion or whatever, right? My point is we're underpaying for the government that we are living under. In order to shore that up, there's a bad four-letter word that we can use to answer what's going to have to happen. And it's MATH, it's math. The math simply says
higher taxes.
Higher taxes are in our future.
Boy.
And so for this couple that's thinking, well, when does it make sense and when doesn't it? It depends on the rate. And if I'm going off of what the Penn Wharton budget model is telling us, what David Walker, former Comptroller General of the U.S. government, is telling us, I'm thinking that they're either going to be the same, in which case it's a push, or they're going to be substantially higher. Now, that doesn't even take into consideration the fact that if I take just RMD only, so I don't do the conversion, I just take money out as I'm forced to, and I think, I don't need that money. I don't need all of it. So I'm just going to reinvest that money into a brokerage account.
Okay.
Now I have taxes on the reinvested dollars. So what I would tell people to do is this. Go to www.stonebridgetaxbill.com. Hopefully we can put this up on the screen. I don't know how that works, but stonebridgetaxbill.com. What you're going to see is you're going to see a simple calculator. You're going to be in control, so you can manipulate the inputs. Put in, hey, you know what? Here's my age. Here's the dollar amount I have in pre-tax IRAs. Here's what I think my effective tax rate's going to be, and it's going to spit out a report to you. You'll put in your email address and that sort of thing, and it'll send the report directly to you, and it'll show you two different kind of what I just visually kind of illustrated for you, or I guess more like auditorily helped you visualize. This will be the actual report. And think about it like mandatory versus optional.
All right.
Your mandatory tax bill is, hey, if you converted all of it today and you're going to be in the 25% bracket, you're going to pay that $250,000 on the $1 million in my example. Okay, I can't change that. Okay, there's things we can do to try to mitigate taxes, sure, but in general, keeping it simple, we can't change it. The optional tax bill is option B, where you defer and then you take RMDs, you reinvest that, and then your heirs pay tax on what they inherit from you, which they now only have 10 years to do instead of being able to spread it out over their lifetime.
Yes.
And it is monumental, the difference. We're talking about somebody with $1 million IRA might spend well over $1 million in taxes between their RMD tax, the tax on the reinvested RMDs and a brokerage account, as well as the death benefit that would be paid to beneficiaries. The tax that those beneficiaries have to pay could be well in excess of the value of the account versus the mandatory amount that I showed you over here. So not specific advice. Mileage always varies, but that's why you should start by going to stonebridgetaxbill.com, and then we'll be in touch with you in order to go through that report as detailed as you want to, or you can even sign up to with one of our advisors, just a 15-minute phone call.
Sure.
And get the details on, okay, what is the answer to this question? Does it make sense for me, and do I need to explore this further?
Very good. Use this phone number also. All right, stonebridgetaxbill.com or 866-295-5146, 866-295-5146. or stonebridgetaxbill.com. Go to the
or
YouTube
Stonebridge,
channel.
you go to our main website,
Yes.
stonebridgeiwm.com,
Yes, yeah.
stonebridgeiwm.com,
Yep.
and just go to the Contact Us, and you can actually request a phone call through our contact page.
Yes, fine. But my point I was going to make is that it doesn't cost you anything. It's absolutely free.
For sure.
And you guys do this as part of, service to the community and so forth. There's no way to charge for a consultation. They don't do that. So use it. 866-295-5146. We'll see you next week, Tim.
Well, we'll see you. Thanks, Jackie.
Hey, there's the music.